If your bank account has no beneficiary listed on it right now, your family cannot touch that money the day you die. Not with a will, not with a notary, not with a lawyer. I want you to actually think about that for a second, because most people assume their will handles everything. It doesn't. And real quick, heads up, this is general information, not personal legal or tax advice, since every state and every bank contract is a little different. Now, here's the first thing most retirees get wrong, because this one alone can keep your family out of your own money for months. Here's the scenario I hear about constantly. Someone spends $150,000 to $400,000 of their retirement savings, moves it into a checking or savings account after selling a house or cashing out a CD, and assumes that because they have a will, everything is covered. They pass away. Their adult kids show up at the bank with a death certificate and a notarized will, and the teller tells them the account is frozen. Not because anything was done wrong, because one specific form was never filled out. That form has nothing to do with your will. It's a separate contract you sign directly with your bank, and if it's blank, your account doesn't go to your kids. It goes to your estate, and your estate goes through probate, the court process that validates a will and distributes what's left on the court's timeline, not your family's. In many states, probate kicks in automatically once an account balance crosses somewhere between $50,000 and $100,000. And most states build in a mandatory waiting period, often 3 to 6 months, so unknown creditors have time to file a claim before your family sees a dollar. Meanwhile, the funeral home still wants paid this week. Here's where this comes from, so you know it's not just a talking point. Bank accounts are governed by contract law, not by your will. The framework most states use today traces back to the Uniform Probate Code, first drafted in 1969 and adopted in some form by all 50 states, which treats a signed bank beneficiary designation as a binding contract between you and the bank, separate from and generally faster than anything in a will. The IRS also weighs in here, but on the tax side, under IRS Publication 590-B, what your beneficiaries owe in taxes on money you leave behind depends heavily on what kind of account it is and who's named on the paperwork, which is exactly why getting the forms right matters twice, once for probate and once for taxes. So let's go through the specific accounts and forms retirees miss, one at a time, and what each one actually costs you if you skip it. Number 1, the payable on death designation on your checking and savings accounts. This is the big one. A POD form takes about 10 minutes at your bank, costs nothing, and it moves your account directly to the person you name the moment the bank sees a certified death certificate. No probate court, no attorney, no waiting period. Every FDIC insured bank is required to offer it. The catch most people miss? It only covers the specific account it's filed on. If you have a checking account, a savings account, and 2 CDs at the same bank, that's 4 separate contracts, and each one needs its own POD form. A lot of retirees file it once on their main checking account and assume the rest are covered. They're not. Go check every account you have, not just the one you use most. Now here's where it gets important. Number 2, the transfer on death designation for brokerage accounts. If you hold stocks, bonds, or mutual funds outside of a retirement account, POD forms don't apply to them at all. Brokerage accounts use a different form called a TOD, and it's filed directly with your brokerage firm, not your bank. It works the same way. It bypasses probate, but it's a completely separate piece of paperwork. A 70-year-old with $200,000 in a regular brokerage account and a perfectly good POD form on their checking account can still leave that $200,000 stuck in probate if nobody ever filed the TOD. Most people don't even know the second form exists because their bank and their brokerage are 2 different companies with 2 different paper trails. Number 3, retirement account beneficiaries, and why an old name on the form can override your current will. Your IRA, 401k, or 403b already transfers outside of probate by design under federal law, but only to whoever is actually listed as the beneficiary on file with your plan administrator. Here's the part they never tell you. A named beneficiary on a retirement account legally controls the payout even over a more recent will, and in many cases, even over a divorce decree. If you opened an IRA in 1998, listed your spouse at the time, and later divorced and remarried without ever updating that form, the ex-spouse can still be entitled to collect the full balance regardless of what your current will says. This isn't rare. It happens because updating a will feels like handling your estate. But a will and a beneficiary form live in 2 completely different systems, and nobody connects them for you automatically. Most people stop here, but don't, because this next one has a real tax bill attached to it. Number 4, how the Secure Act changed the tax clock for inherited IRAs. If you leave a traditional IRA to an adult child, under the Secure Act of 2019, most non-spouse beneficiaries now have to empty that account within 10 years of your death, and depending on IRS guidance finalized under the updated regulations, they may also need to take yearly withdrawals during that window rather than waiting until year 10. Every withdrawal is taxed as ordinary income to your child in the year they take it. Picture a retiree with a $400,000 traditional IRA, leaving it to a daughter who's still working and in her peak earning years. If she's forced to pull large chunks out during her highest income years, some of that money can get pushed into a higher tax bracket than if the withdrawals were spread out more deliberately. A Roth IRA follows the same 10-year rule for non-spouse heirs, but the withdrawals themselves are generally tax-free, which is why a lot of retirees intentionally convert part of a traditional IRA to a Roth over several years, specifically to reduce the tax bill they're about to hand their kids. That's a bigger decision with real trade-offs, and it's worth a conversation with a tax professional before you do it. But knowing the 10-year rule exists is what starts that conversation. Number 5. Joint ownership and the hidden cost of adding your adult child to your bank account. A lot of retirees add a son or daughter as a joint owner on their checking account so that person can help pay bills if something happens. The intention is good. The legal effect is bigger than most people realize. The moment your child is a joint owner, in most states, that account is treated as partly theirs right now while you're both alive, not just after you die. If your child is sued after a car accident, goes through a divorce, or owes a tax debt, a court or the IRS can potentially reach into that joint account because your child's name is legally on it. A POD designation avoids all of that. It gives your named beneficiary zero ownership or access while you're alive. The account stays entirely yours and entirely protected from their creditors, and it only transfers after you pass using a certified death certificate. If your goal is just giving someone the ability to pay your bills while you're alive, a power of attorney does that job without putting your money at legal risk. Number 6, the safe deposit box problem almost nobody thinks about until it's too late. If you keep your will, deeds, or valuables in a safe deposit box and hand a spare key to your child, that key alone often doesn't guarantee access after you die. Banks routinely seal a box once they're notified of a death, sometimes until the estate is formally open, which creates a frustrating loop if your actual will is locked inside the box you can't open. The straightforward fix? Add your child as a joint renter directly on the safe deposit box contract at the branch in person with both signatures on file. That's a completely different form from your POD designation, and it's one more thing worth checking this week while you're already at the bank. Here's the part that ties all of this together. Number 7, none of these forms are permanent, and outdated ones are often worse than missing ones. An old beneficiary, an ex-spouse, a sibling you've lost touch with, someone who's since passed away, is still legally who the bank or the plan administrator sends the money to, no matter what your current will says or how obviously outdated the name is. A good habit is reviewing every beneficiary designation you have: bank, brokerage, retirement accounts, even life insurance, roughly every 3 years, or immediately after any major life event. A marriage, a divorce, a death in the family, a new grandchild you want to include. So here's your one concrete step for this week. Go to your bank, in person or through your online portal, and ask specifically for the Payable on Death designation form for every account you hold there, not just your main one. While you're there, ask whether you have a safe deposit box and whether your child needs to be added as a joint renter. Then log into your brokerage account and your retirement account provider's website and check the beneficiary section on each one. Most let you see it and update it online in a few minutes. No paperwork required. Do those 3 checks this week, and you've closed the 3 biggest gaps that leave retirees' families stuck waiting. If breaking down the rules the IRS and your bank don't explain to you is useful, hit subscribe, because every week I go through exactly this kind of thing. The parts of retirement finance that affect real money but never get explained clearly. Next time, I'm covering how required minimum distributions actually get calculated and the penalty most retirees don't realize they're exposed to if they get the timing wrong.